Welcome. I'm Austin Shepard. I'm President and CEO of Fiduciary Trust Company, and we're delighted to have you join us today for our third quarter market outlook. Today's special. To the standpoint, I'm happy to introduce and welcome our new Chief Investment Officer, Frank Brochin. Welcome, Frank.
Thank you.
We're delighted to have Frank here, and we have a number of events planned in the fall as an opportunity to get to know Frank. But I thought today maybe I'd ask maybe one or two questions at a high level, maybe starting off with just a little bit about yourself and how you became an investor.
Well, I think it's fair to say I grew up far away from the world of investments and investing. I grew up in a small village in North Africa where there was one school and two teachers, my mom and my dad. I learned to read, write, and count with them. We moved between Algeria, Morocco, eventually France, and then I got a scholarship to come and study in the US. I did my PhD at Princeton, and from there I went to work still as in the technology world as opposed to the investment world, working for NTT, the telecommunications company in Tokyo. And it's only when I came back to the US to do an MBA 3-4 years later that I eventually started to learn about investments and the investment world. Started my career shortly after that with a private equity firm, one of the leading private equity firms in the US, and learned about investments prior to eventually working in the emerging market space when I built my own firm after my private equity experience, and eventually leading the family office practice of a wealth management firm.
Wow. Frank, I know you're very well traveled and versed in many different things, and so we're delighted to have you. Maybe what would be helpful also today is just at a high level, what of those experiences have informed how you think about allocating capital?
Well, one thing that I learned that when I was doing private equity was that domain expertise is very important. I was working for a firm that prided itself in having people who could become experts in certain industries. And so my whole career in the world of investments, I've been focused on finding managers and investment ideas where domain expertise matters. I like to say that I like to find managers who have a deep knowledge of what they own and why they own it. And that has really shaped the way I think about investments.
Well, I say, again, one of the reasons we're delighted to have you is that resonates with how we've historically approached investments. And so to have you here at the helm, we're delighted. And
Thank
so,
you.
Again, as I mentioned, we're going to have further opportunities in person to get to know and learn more about Frank. But for today, we're going to follow our traditional format here, and we're going to turn it over to you, Frank, to offer some prepared remarks regarding the markets. And then I'll come back at the conclusion for some highlight questions. So with that, let me turn it over to you.
Well, thank you, Austin. I'm going to show a few charts here. The thing to say is that we had a very, very good quarter. In fact, we had a fabulous quarter. The emerging markets, as you see on the charts in front of me, emerging markets did extremely well. They were driven by semiconductor stocks, in particular in Korea and Taiwan. The US, which is important for our investors, did well as well. The S&P 500 was up 14% for the quarter, and small caps did even better. So overall, we had a very, very strong quarter. And the question for investors is, will this continue? And we believe that for now, we have the wind at our back. If you look first at the economy of the United States, the economy is very strong. Capital expenditures are very strong. They are driven by AI capex from a variety of companies, which we will discuss in a minute. Corporate profitability is very strong. If you look at the S&P operating margins, they reached 17% for the second quarter, which is very high. The forecast for 2027 Q2 is 20%, which would be an all-time high for operating margins. Operating margins, capital expenditures, labor is also very strong. Unemployment is low, 4.3%, and very stable. And finally, consumer spending, which represents 2/3 of the US economy, is also very strong. You have a bifurcated economy, as some economists have pointed out, with the high-income spenders actually fueling the trends for consumer spending. Driven in part by the fact that they're making more money from the stock markets, whereas the low-income families are actually somewhat squeezed by a decline in their real disposable income. But overall, consumer spending is still very strong. So the economy is not a source of worry at this point. We feel that it's very stable and on solid economic foundations. The most important thing about the market these days is that it's actually not driven by valuation multiple increases. If you look at valuation multiples for the S&P 500, they have actually declined over the past 5 years, and they have declined year to date as well. So we started the year at about 22 times forward for the S&P 500. We ended the quarter with a 20.3 times forward as a valuation multiple. So it's not a valuation multiple story, it's actually an earnings story. If you look at the US, earnings are growing at 23% this year, and they're forecast to grow at 15% next year. In fact, it's not just a US story, it's also a global story. In developed markets, the expectation is that earnings will grow at 20% this year, while in emerging markets, it is expected that they will grow at 60% this year, which is a huge number. So when you ask whether this stock market can continue to rally, the real question that you're asking is whether earnings can continue to grow. And we believe that they can continue to grow because AI is actually driving earnings. If you look at the chart in front of me here, the top contributors for the earnings growth for 2026 for the S&P 500 are mostly AI-driven companies. You have Micron, you have NVIDIA, you have Broadcom, you have all of the so-called hyperscalers, Microsoft and Alphabet and Meta. If you look at AI, AI is actually a big driver of that increase. And AI is actually driving earnings in several ways. AI is driving earnings through what you could call the global rollout of data centers. Data centers are being rolled out on a global basis, but also in particular in the US. And even though a lot of the capital expenditure is on equipment from Japan and Taiwan and Korea, you still have significant gains by US companies which are participating in the rollout, whether they are construction companies or power supply companies or power distribution companies. You also have gains through the wealth effect. I mentioned earlier the high income families across the United States spending more because they have realized gains in the stock market. That is something that's important. A lot of companies are seeing their earnings rise because of increased consumption by that segment of the population. And then finally, you have essentially productivity increases across the board, and that's probably the most important effect. A lot of companies are requiring a lower amount of capital and a lower amount of labor in order to produce the same economic output. So that is very important, and this is one of the main reasons why we think that AI will continue to drive productivity across the board for companies. Is this the end of this boom? Are we closer to the end than the beginning? We think that we're still very, very much at the beginning. If you look at the global data center rollout over the next 4 or 5 years, McKinsey estimates that between now and 2030, the global data center rollout will represent nearly $7 trillion of investments. This is actually, an enormous amount of capital expenditure, and we're still at the very, very beginning of that trend. You can see it actually in the forecast of the so-called hyperscalers, the Microsoft, Meta, Amazon, Oracle of the world. And you can see how much they have forecasted that they would spend in the coming years. The chart in front of me actually shows the CapEx on the quarterly basis, and you can see the curve going up and to the right. There's an unprecedented amount of capital expenses which are being planned by these companies. Just to give you a sense of numbers, it is estimated that in 2026, they will be spending $600 billion in AI-related capital expenditures. For 2027, that amount will grow to $800 billion. So those are very, very significant investments. So in summary, we think that the economy is on solid foundations. The stock market is not driven by valuation multiples. It is driven by earnings. AI is actually driving these earnings. And the AI boom that is driving the earnings is still at a very early stage. And so we feel comfortable that overall we're in an attractive situation for the market. Of course, there's always a few things to worry about. Inflation is one of them. The availability of capital could be another issue. But overall, we feel actually fairly comfortable with where we are today. We still would recommend to our client to apply the basic rules of investing. First, be patient. As they say, time in the market is more important than market timing. Think about asset allocation. Asset allocation will be the key driver of the performance of your portfolios. Portfolio construction will continue to matter. Having a diversification across asset classes and across strategies that sort of balance and offset each other is extremely important, especially at a time like what we have today. And finally, diversification will remain your friend. Back to you, Austin.
Thank you, Frank. Thank you for those insights and those perspectives. I guess, taking those points all together, one of the things I contemplate is the standpoint that we just had the largest IPO ever. We've had a series of highest marks in the S&P 500. We have a level of AI investment, I think, unheralded in our time. Is this a bubble?
That's always a tricky question because you find out if it was a bubble after the bubble burst. But I do not think this is a bubble. And I believe it's not a bubble, even though we have some froth in the market, even though the level of margin debt is fairly elevated, even though investor sentiment is very high. But I think it's not a bubble because, as I mentioned earlier, valuation multiples are not the factor driving the market. Earnings are driving the market. And in every bubble I have seen, valuations went through the roof. At the same time, typically as return on capital invested was going down. Here, return on capital invested is still high, it's stable, it's actually growing. It's been growing over the past 10 years. And so I feel comfortable that with growing ROI, valuation multiple declining, and earnings very strong, we still can trust this market.
Frank, let me ask one follow-up question, which is the standpoint of we have earnings and we have multiples. And if we feel sort of comfortable on this, a lot of reliance around the earnings. And my general sense is that the earnings may be fairly concentrated in a few companies. And does that cause you any concern going forward?
It's true. That's maybe one area that we need to monitor going forward. If you look at earnings growth for the sort of AI-related company, I was looking at a basket of stocks related to AI recently. Earnings growth was about 40% for the year. You look at commodities, earnings growth was in excess of 50% for the year, although things have changed recently and they continue to change with the war in Iran. And if you look at everything else, earnings growth was only in single digits. So it's fair to say that AI, as I mentioned earlier, has been driving earnings and that it's sort of fairly concentrated, and that's something to monitor. But overall, I think that the impact of AI on the economy at large will be strong. That's one of the factors driving AI earnings. As I mentioned earlier, many companies are benefiting from AI by having more economic output per unit of labor and per unit of capital. And so we can feel comfortable that this concentration will actually not hurt us.
That's right. As you talk about AI, I think about the next decade, right? Mm-hmm. And obviously a lot of the investment behind it is not only for this year, but hopefully, future many, many years, right? Other than AI, what other opportunities do you see for long-term investors who have a horizon that is 10, 15, 20 years out there? And how do you think about those?
I think the best place to invest over the next 10, 20 years is developing Asia. If you look at developing Asia, in every single country from India to Southeast Asia, you have a socio-economic transformation taking place on a massive scale. People are moving from the countryside to the cities. They used to be farmers. Now they're going to work in services. They're going to work in manufacturing. They're going to produce more economic output per person, if you will. Their own individual GDP is going to grow. They're going to earn more. They're going to save more. By saving more, they will actually be able to provide capital to growing companies indirectly. And by spending more, they will be actually fueling the growth of companies providing goods and services to what you could call the rising urban middle class. I think this is a phenomenon that we have seen actually in every single developed country in the world. At some point, they went through that transformation We're seeing it happening in India. We're seeing it happening in developing Asia. We saw it happen before in Japan, Korea, Taiwan, and China. And I believe that over the next 20 years, we're going to have great opportunities to invest and have the wind at our back in those economies. And we're going to try to find ways to access these opportunities here at Fiduciary Trust.
Exciting. Oh, good. Well, I want to offer one other question here before we wrap up. What else is at least on your mind or keeping you awake or as an itch that you are looking to explore further?
Not keeping me awake, but something that I think about a lot. I think we're looking at a very different world going forward. We're just coming out of a world that was profoundly deflationary in nature, a very efficient world where trade was relatively free, where the capital was moving very fast. And we're going into a world where you're going to have trade barriers, you're going to have reshored supply chains, you're going to have defense spending, you're going to have no longer just-in-time inventories, but just-in-case inventories, where countries and companies are going to try to build reserves of all kinds of commodities. And in that new world, any crisis would be sort of inflationary in nature. So we're going from a deflationary world to an inflationary world, or at least an inflation-prone environment. And in that new environment, I think that the traditional relationship between asset classes is no longer going to be the same. So bonds and stocks are not going to move in the way they have moved in the past, and bonds in particular are not going to provide the same offsetting sort of characteristics compared with stocks. And so we have to think about this at Fiduciary, and we have to understand how we're going to construct portfolios going forward. And I suspect that we're going to do a lot of work in this area over the coming weeks and months.
I'm excited. I'm excited to have you here at Fiduciary. I'm excited to have your experience as an investor with families and institutions, and I'm looking forward to the work ahead. And particularly, I'm looking forward to everyone joining us in 3 months when we get together for our fourth quarter market outlook. And as I mentioned, we will also be having a series of gatherings as an opportunity to meet in person with Frank and hear more opportunities about some of these things that we're spending some time on. So thank you for joining again today, and we look forward to seeing you soon.
Thank you for joining us today. If you'd like to learn more about Fiduciary Trust and access more of our insights, please go to fidtrustco.com. Or if you'd like to speak with us, please reach out to a Fiduciary Trust officer or Sid Queller at 617-468-7919 or Queller at fiduciary-trust.com. Thanks again for joining.
The opinions expressed in this material are as of the date issued and subject to change at any time. They discuss general market conditions and trends and should not be construed as investment advice. Any reference to specific securities are for illustrative purposes only and are not intended to be and should not be interpreted as recommendations to purchase or sell such securities. Nothing contained herein is intended to constitute investment, legal, tax, or accounting advice, and you should discuss any proposed arrangement or transaction with your investment, legal, or tax advisor. Copyright Fiduciary Trust Company.